All right, it is 2 o'clock. So per our scheduled start time, we'll go ahead and get going. For those that join late, they'll have to catch the beginning in the recording later on. So just an FYI, when you logged in, you should have been notified that this is recorded, and we do post it on our website later on. So if there's something that you thought about, like, hey, I want to reference that again later, know that that option is there. It's on our COVID-19 resource page on our website. So make sure you keep an eye out for that. My name is Lacey. I'm the Director of Education. Here today to introduce our very own Mr. David Arbett, Director of Economics and Research. We're super fortunate that we have him, and I think what we've found is there's people coming back every week because they like him so much, just like the rest of us. So just a few things to note today. You are muted right now, and throughout the meeting, you could unmute yourself, but we're asking that you hold your questions until the end of David's presentation. Or if you could just type them in the chat and we'll capture them and make sure to address them again at the end if David didn't answer them. We'll have about 5-10 minutes probably at the end for David to answer questions. So don't worry, we'll make sure that if you do need to get out of here by 3 o'clock, that you can still hopefully get those questions answered. But that's pretty much all I have for you guys. The other thing, I guess maybe I'll make a shameless plug here for my own department, is that we do have CE up and running. So make sure you check out our website for upcoming classes, and know that David is back here every Thursday, at least through May at 2 o'clock. And then on Monday, Eric Myers from Government Affairs will also be doing a weekly market update, but a weekly update to talk about the national, local, and state level government impact on your business. So make sure you get a chance to sign up for those too. So I will, like I said, stop talking and make sure to turn it over to David here. He's got a lot of great information for you. So take it away, David.
Thank you, Lacey, and really appreciate Lacey and Rosie and everything their team has done to facilitate these. So thanks to you guys, and pretty exciting news on the CE front. So our whole team is working pretty hard to keep you guys, what are our 3 Ps? Productive, protected, and profitable. Three of the good Ps. Okay, welcome. Thanks for being here again. I guess you'll see me on the screen here. That's a picture of me. I don't always love to start these with a photo of myself, but here we are. So many of you I know were here last week, and I want to thank you for coming back again for more fun and excitement. I know some things have changed, and it seems like some of the sentiment has changed out there. So we're going to see how much of that is kind of reflected in the numbers. Okay. Already kind of did my introduction, but welcome again to the update on the Twin Cities residential market activity and the impact of CV-19 here on April 23rd. I'll reiterate what I said last week. The only thing that really matters is that you and your loved ones are safe and healthy and well, and hopefully not getting too stir crazy. I will also put in a shameless plug for our resource page. Our team has invested quite a bit of time making sure you guys have all the resources you need to stay informed. So please do visit that page if you haven't already. Lots of resources at the local, regional, state, national level, covering all sorts of different items. You know, like Lacey said, thanks for your patience and understanding. Just like you guys, we're learning to navigate this new normal, or whatever you may call it. Also, if it sounds like I can't perfectly predict the impact of pandemics on housing market activity, well, it's probably because we can't. Also, please keep mics muted as much as we love your barking dogs, wind chimes, and the sound of you slurping your coffee. Okay, so same as last time, everything depends on 3 things: the length of the pandemic, the impact of unprecedented levels of stimulus and relief, and the consumer response or reaction and how that drives consumer spending and consumer behavior. All right, let's take a look at showings. This is showing activity in the North Star system. You guys can see this goes back to Jan 01 of this year. And then we had to wait a week to have that first point because this is a rolling weekly average. You know, this one really paints the picture, kind of demonstrating just how different the first half of March was from the second half. And, you know, that's going to carry through. That's a trend that's going to carry through to a lot of the slides and content that you guys are going to see today. So I just want to kind of spell that out. You know, notice, I think the big point to notice here is that March 15th, the closure of the schools, that was really what set off our slide in showing activity. You guys can see we saw a little bit of stabilization around sort of later in March, but that looks like sort of a false positive there, because after the shelter in place order hit, you can see showing activity declined a little bit further. You will also notice that since last time, there has been a bit of a change. We have seen a pickup, even an acceleration in showing activity. So we're not quite all the way back, but we're actually almost 50% back from our decline. So I think that's pretty interesting. And again, I think it's consistent with, I guess I'll call it shifting sentiment and evolving sentiment among people. You know, we see a lot of movements about reopening and all sorts of questions like that. So perhaps folks are getting out there a little bit more, and they're getting into some homes and some showings, which is a good thing, assuming, of course, it's done safely. So we see this acceleration in showings. What's going on? How do we think about this and explain some of this? Well, have all of the health concerns magically passed? Are those all gone? Safe to say, probably not. Okay, what about, are rates just too good to pass up? We'll talk about this a little bit later. How about stimulus checks and those relief checks? Are those just making people feel flush and they're ready to get out there and start swinging at some listings again? Maybe people are just a little stir crazy and they need to do something. Maybe couples suddenly need more space, or a home with 2 master bedrooms, or 4 home offices. All right, I had to throw that one in. Do we have an overreaction, folks? You know, I think, well, experts say that this wasn't worse because we stayed at home. So let's keep that up. Thought of the week. This comes from Dr. Eisenberg, using China as a case study. So we've heard politicians argue about, you know, who, how, and when to reopen the economy, but I think ultimately it's consumers and businesses that will make that decision, and it's going to be based on safety and how secure they feel going out to bars and restaurants, going into stadiums, going into shopping malls, etc. We've seen some early evidence from China, which we all must acknowledge is not the most trustworthy data source, but it's a little bit of a surprise to the downside. So March retail sales were actually down 19%. Now, not everyone was kind of getting back out into the community. Some folks were still quarantined into March. April will look a little bit, I think, better in China, but perhaps worse here, but we'll have to see. So this does suggest that the combination of behavioral changes and this material loss of wealth and income could be holding back consumption. Again, there's a possibility that China could be understating that decline. So that comes from Dr. Eisenberg, just something to think about. Okay, so last time we also discussed some things regarding, you know, different activity and different dynamics at various price points. We've seen some confirmation of that trend, and other data has sort of complicated that trend a little bit. So I'm going to try to run through this as best we can with you guys. So we're still seeing that the slowdown is the most noticeable in the luxury segments. But again, there's some evidence that some of those luxury segments are snapping back as well. So we'll dive into that. There is this wealth effect where luxury buyers are more affected by you know, dynamics in equity markets and in stocks. And this perceived wealth effect can actually affect confidence, spending, you know, major purchases, and other behavior. So thus, perhaps 1 million plus market activity could be softening a little bit. On the other end of the spectrum, how about younger first-time buyers, hospitality, leisure, restaurant, bar, retail workers? A lot of those folks lost their jobs and may not be as likely to purchase. Or, you know, perhaps they've just delayed or postponed their plans. And NAR actually has research showing the majority of folks did just postpone instead of cancel outright. And I think I'll get into that later as well. So perhaps then those folks under 200 or 250 may also be slowing down a little bit. we still see strong demand and weak supply in that 2 to 300 segment, as I know all of you know. And so this could keep prices kind of firm and propped up, again, depending on the length of the health concerns. So again, we have this theory, if the top and bottom could be a little soft, perhaps the middle will perform the best. And by the way, I want to say more data on this, on the severity. Look at the job losses in leisure and hospitality. I think I've got my laser going here. A lot of the heaviest hit, the heaviest hit sector was leisure and hospitality. And we got to think about what product those consumers, or I should say those workers, what segment are they shopping in? I think I got one more real quick. We should also note, I know we noted this last time, a lot of the job losses, unfortunately, have been among those with a high school education and less. Again, there's overlap there with some of the industries that were hardest hit. So just so you guys kind of know, and we can all be in the know and sensitive to some of these changes. Okay, so change in showing activity. So careful here, you guys. This is a little bit old, but I wanted to keep it for a couple reasons. First of all, sure enough, right? We've kind of proven our theory, kind of. You see a fairly sharp pullback in activity, as you get into the luxury price brackets, maybe 800 to $1 million, and surely $1 million plus. That's where you see 40 to 45% declines. Again, you also see some declines in these affordable brackets as well, but perhaps less of a decline in what we called last week these middle market segments. So 350 to 500, maybe 350 up to 600. I know 5 to 6 gets to be a little bit out of reach for some folks, but it's not all the way up in these luxury brackets. So just so you guys know, the middle markets here seem to be performing the best, at least as of 3 weeks ago. And so this was showing activity. So let's see what we have next. So here's the change in showing activity from 412 versus 45. Not as much of a clear picture, right? So this one looks a little more complicated, where you see, gains in affordable, losses in affordable, gains in affordable, losses in middle market, gains in middle market, a loss in the early, maybe the lower luxury brackets, and then you see these gains as you get into a little deeper into the luxury brackets. So again, this seemed to be, it was pretty easy to read the tea leaves here. Here it was much harder. And now let's compare 412 to 419. So this is the most recent data we have. And I just want us to look at this change in showing activity. So this is new data. I think we included this in our Monday blog, which of course we encourage you all to check out. I know you guys will get a kick out of it. So overall, we saw this 40% gain in showing activity week to week. That's a big number. We can see, though, that, of course, there's activity on either side of that 40%. We see some ranges kind of below that 40%, and we see several above that 40%. The big thing to keep in mind, some of you may be wondering, well, if it's 40% and only 1, 2, 3 price ranges were below, how come these aren't moving that number more? Well, guess what? There's just not a lot of showing volume here. So even if you had 100% increase, that may be from 12 to 24 showings. So an additional 12 just isn't going to move the market all that much when you have 3 or 4 or even 5,000 showings. But again, from this was really clear that things were headed downward. This was not as clear. Some things were up, some brackets were down. This is now pretty darn clear that things are coming back, again, at various paces across different areas and price segments. And, we haven't yet broken this down by single family condo townhouse. I'd like to, but, it's safe to say that activity will vary by price point, by local area, and by, property type or construction type. So again, pretty clear evidence that things are coming back here, which we saw from that orange trend line. But again, this shows activity by price point. So pretty compelling data here. Again, we're thinking about those first-time buyers and what's happening in different price points. I know we mentioned this last time. Last year, about 1 in 3 buyers nationally, 1 in 3 buyers was a first-time buyer. And we can see that's down from maybe 40, maybe 38 to 42% on average, going back into the early 80s here. an interesting data point here, 50% of buyers were able to be first-time buyers in 2010 when home prices went on sale. As we've seen prices continue to march higher, we're seeing that, you know, a little bit, first-time buyers are making up a little bit of a lesser share. We had this one as well, so I just want to cover this one for some of the new folks joining us this week. First-time buyers, median age of home buyers. Here's our first-time buyers. Used to be 32, 30, 32. As home prices went on sale here in 08, 09, and 2010, actually 30-year-olds could be first-time buyers. Again, that's a median. Some 40-year-olds were first-time buyers. Some 19-year-olds were first-time buyers. As time has gone on and as prices have risen, now those first-time buyers are a median of 33 years old. All right, a little bit of levity here. Millennials living through their second once-in-a-generation economic collapse, giving each other an elbow bump, and they're just really, really excited about everything. Millennials finally stopped going out for avocado toast, so can we all now magically afford a home? Not so fast. So a note on showings. I've heard some builders say that the showing traffic is still down, but it seems to be a higher quality buyer, a higher quality traffic that's coming from more motivated buyers. So I thought that was pretty interesting. Again, I don't have data on that, so I can't say that with 100% certainty. Just wanted to pass along that anecdote from some of our friends in the builders and developers and construction side of our industry. You know, perhaps the true qualified buyers have stuck around, but some of the fringe buyers or the snoopers, you know, I want to see what my neighbor's home looks like. Maybe some of those folks have kind of dropped out. Okay, let's look at overall showing activity by price range. So this is our previous week. So our week ending 4/12 versus the one ending 4/5, and we can see that you know, based on the gray bars, we can see some gains. Gain here, gain here, gain here. We had a loss here and a loss here, and these are a little bit tougher to read, but you know, not a huge amount of change here. Okay, so again, some up, some down for that week ending 4/12. You guys ready for the next one? Right. We see a lot more growth from week to week on the showing side by price point, pretty much across all price ranges. So let me just go back and forth for you guys, just in case you missed it. Look at the blue compared to the gray. So here's the prior week. Here's the current week. Prior week, current week. You can really see the growth in those gray bars. And I think that paints a pretty compelling picture. And again, it's pretty consistent with what we're seeing elsewhere in our data and elsewhere, you know, out there in the data world. Sometimes it's a little bit tough to see exactly what's happening. So in addition to looking at the showing activity, what about the share of activity by price point? So for the week 4/5 compared to 4/12, so homes under 200,000 comprised about 24% of showing activity in the previous period versus about 25% of showing activity in the more recent period. So again, some segments gained share, some lost, some gained share, some lost. Over here in our luxury brackets, I actually had to take this out to the hundredths place just so we can see, because this would look like 2.2 to 2.2. We can actually see a decrease in share here, an increase in share from 800 up to 1 million, and then an increase in wealth for our properties that are over 1 million. How about we shift gears to the most recent data? So let me just do that back and forth for the week of 4/12 versus 4/19, week of 4/12 versus 4/19. So for the most recent week, we actually see a decrease here and a decrease here in these two pretty affordable segments. And then we see a fairly notable growth here for 250,000 up to 300,000. We also see fairly notable growth in this 350 up to 450 range. Oddly enough, and frankly, I'm a bit surprised by this. We actually saw a little bit of deterioration in the market share from week to week for homes between 300 and 350,000. Again, increases in all of our luxury segments, some of them actually fairly significant. All right, let's shift gears a little bit. I like to open with some detail and maybe then zoom out a little bit and try to think about the bigger picture. So new listings, again, going back to roughly the beginning of this year, maybe more like mid-January. We can see our current trend here in blue, along with, or I should say, co-plotted alongside our year ago trend line here in gray. So new listings, seller activity, a simple count of the properties that have been listed on the market during a given month or a given week if it's weekly, or month if it's monthly. So again, we can see a sort of mid-March hit, and we started to see these declines in seller activity at a time when we would expect gains. Last year we saw gains. You know I mentioned last week, I'll reiterate this week, 2019 may not be the very best year to compare against just because of some of the weather anomalies. And I know early 2019 actually had pretty high rates. I think rates spiked in late 2018, headed into early 2019. So again, maybe not the best year to compare against. That's why we have many more years to compare against. So don't you worry, I've got a slide for that. So this is new listings. Let's pivot over to pending sales. Again, we've got current year in blue, plotted against year ago here in gray. We can see a couple weeks ago, or maybe about 4 weeks ago, we saw this cross where last year's activity actually got above this year's activity, despite this year actually spending the majority of the majority of the first quarter above 2019 levels. So clearly something happened here, and we know what it was, and we can see the impact on the numbers. Inventory. So again, at a time when we would expect the number of active listings or the count of homes in active status or for sale properties, right, we'd expect that number to be rising as it did in 2019. Instead, this year, we were rising maybe surprisingly up until the end of March. And then just in the last couple weeks, we've seen a little bit of a decline, but not a huge decline. Okay, so this is a new one. Hope you guys are as excited as I am. This is change in new listings by price point for the week ended 4/19 versus the week ended 4/12. So sometimes this is confusing. When you see a gain here, you guys, that means obviously 4/19 was higher than 4/12. On the seller side of the equation, I think the big things that pop out to me is that sellers over 500,000, are down anywhere from a fifth to about a quarter. Some of the other sellers, down a little bit, 4 or 5%. Actually, we saw a gain here in 250 up to 350. So sellers listed 4.25% more homes for sale for the week ended 4/19 versus the week ended 4/12. 0% change, so very flat here for our friends in the 350 up to 500 segment. So of course, if we show the change in new listings, we have to show the change in pending sales, just to kind of compare or maybe contrast buyer activity and seller activity and how those dynamics may be affecting, market times or the ratio of sold to list price or home prices and so on. So let's shift gears into pendings here. And just in case we missed it, I want to do my back and forth trick. I hope you guys are okay with that, but it kind of helps us see some of the changes. So this is change in seller activity versus change in buyer activity. Change in seller activity versus change in buyer activity. Already, I think the big observation here is that our one gainer on the buyer side was 350 to 500. Our one gainer on the seller side was 250 up to 350. Now, I think that's just a fascinating trend. Why? Well, because buyers have been really thirsty for, high quality, move-in ready, updated product in good school districts relatively close into job centers here in this segment. And finally, we actually saw an increase in seller activity there. But, but the increase in buyer activity was a little bit of a leg up, at that 375 or 425 price point from 350 up to 500. Maybe as the buyers see some more activity here, right? So as buyers see that sellers actually listed more product here, maybe that'll start to mean, next week or in the coming weeks, we may see more offers on more of that product there. Let's shift gears to our luxury segments here. Again, sellers down, what, anywhere from 20 to 25% roughly. Buyers only down 12%, 20%. Okay, so 33% pullback here in million plus. So that's pretty interesting. Sellers only listed 23% less product. Buyers made offers on 33% less product. You know, that segment is already fairly oversupplied. So again, we'll have to see what happens moving forward. All right, so here's where I said, don't you fear. We have a slide and a chart for that, as we do many, many things. So this one looks at daily new listing count, again, using our rolling weekly average. And we have co-plotted 2020, 2019, 2018, and 2017, all on the same chart, going back to the beginning of the year. So, you know, this is how new listing activity looked in 2019 around March 12th. This is how new listing activity in 2020 looked around March 12th. So again, you know, around that middle of the month when the whole world kind of changed for us, you can see seller activity slacken or soften just a little bit. Again, as we saw some differences and you know, different media reports around the extent of it, and different, you know, like we saw with the showings, the school closure versus the state of emergency and the stay-at-home order, you know, that affects these metrics differently. So we can see new listings down a little bit. Looked like we had a little bit of stabilization. We had a little bit we had another leg down a little bit. I do see a little bit of a flattening out. Now, we did see that a little bit here, and it didn't turn out to lead to any kind of recovery. So again, I'm pretty hesitant to say, you know, we're at a local bottom here, but we have stabilized a little bit. I think we'd like to see seller activity come up just a little bit, or at least stay fairly flat. Yeah, and we can kind of see how this compares to different years. So that's on the seller side. Let's again pivot to the buyer side. Signed contracts, pending sales. So not quite closed sales, but pending sales. And again, right around that middle of the month, mid-March, we started to see this indicator soften just a little bit. We have now crossed over most of the other years. You know, when you really think about it though, I don't know, 140 versus about 180. So maybe that's what, 40 or 50, you know, on average pendings per day. Well, over weeks and months, that definitely adds up. But I think some folks are imagining that this trend line is actually somewhere down here, or even worse down here, and that's just not the case. So I think we ought to be, deliberate and conscientious around that. So again, on the buyer side as well, we have seen these declines, not quite as much pauses and maybe artificial stabilization as we've seen on the seller side. A little bit more of a consistent downtrend here. A little bit of an uptick, came back down. We'll have to see if we have any other upticks that could indicate, you know, buyers are ready to come back a little bit. Okay, a little bit of a sneak peek. I made this joke last time. I'm talking about a sneak peek to see, not a crafty, sly mountain there. All right, anyway. So this one is March numbers, change in new listings by price range. Again, this is March, so this is a monthly chart, not a weekly or a rolling daily, rolling weekly chart. So this shows the change in new listings by price range for March. And again, you know, we can kind of see this trend where we see weakness on the far affordable end of the market. We also see some weakness in, I suppose, one of our luxury brackets. I guess we technically saw a gain in seller activity over 1 million. I wonder if we'll see buyers as excited as sellers over 1 million. My guess is no. Again, it's really these middle market segments, you know, 190 may be a stretch, but call it 200 or 250 up to maybe 500 or 600. Again, this 10% gain in this range, that could have been, you know, 90% of that gain could be for homes between 500 and 550,000, because we know that the volume does trickle off a little bit as you get up to 750. So just know that a 10% gain here does not mean that every seller who's listing a $750,000 home, you know, it doesn't mean there was 10% more of that. It just means in this whole price range. So a little bit of a, interestingly, a little bit of a normal curve here, where you have sort of activity on the tails, and then the bulk of the activity is sort of in the middle. So, you know, some folks may be surprised by this 33% gain in seller activity for homes between 250 and 350K. All right, sellers, let's pivot over to buyers. So again, pending sales, let's just right off the bat here, folks. This 9% gain in million plus sellers was met with a 36% decline in million plus buyers. So sellers, luxury sellers over $1 million, you know, a little bit excited, trying to get some product on the market. It seems like buyers were having none of it, at least not for March. We'll see how April, we'll see how April plays out. Again, pretty steep declines, again, in our far affordable end of the spectrum. You know, a couple notes here, you guys. It's a wonky segment. You know, there used to be a lot of investor activity here. I think less so. But remember, so much of this stuff that gets snapped up and off the market, it's just not replenished. So, you know, builders can't produce here. A lot of folks who own anything here, you know, may not be selling it because they either may not be ready to move up, or you know, financial hardship, or maybe they can't find an affordable home at a comparable payment close to work or school or family, you know, for a similar, you know, similar price point and similar payment. So every year, you know, we do see this segment decline because it just kind of evaporates and it's not replenished. You'll have some pretty cheap, pretty small one-bedroom condos that are maybe 600 or 700 square feet. Every now and then, you know, you'll see some of this come on, but it's a pretty thin segment. And, you know, as you guys can see, the bulk of our activity in a market with a median price of about 300, I think we're 290 or 295. Obviously, you know, it's going to be kind of in those segments. So 30% increase of signed purchase agreements for homes between that 350 and $500,000 mark. Not that much of a difference, about a 26% increase for a $250,000 up to 350. Talked a little bit about that normal distribution. Don't confuse it with a paranormal distribution. Okay, guys, you know, we talked a little bit about this last time. I'll mention it briefly, but I don't want us to spend a ton of time here just because March was a little wonky, right? The first half of March looked very little like the second half of March. So we know that. Actually, the first half of March was going kind of gangbusters until the second half of March. So overall, we did see this 16% increase in seller activity for March. Again, I would ask you to take that with a grain of salt. We saw an 11% gain in signed contracts, another 11% on closings. Homes sold about 9% faster, 60 days on market versus 66. We did see prices rise 8% from 275 up to 297. So that's why I was saying we're about a 295 to 300,000 market as far as median price goes. For the year so far, we're more like 285. In terms of price per square foot, you're more like 165 per foot. I know some of you love this metric and I know some of you hate it. Please don't throw virtual tomatoes at my screen. I don't know if that's a thing, but don't do it anyway. Sellers yielded about 99.25% of their original list price. So, you know, sellers are still getting a pretty high share of their asking price. And still, we've got about 1.7, 1.8 months of supply. So a very tight market, still a seller's market. So I know you guys, well, I believe some of you have at least seen these on the Showing Time page. It is right on their website as well. It's also, I think it's still on the landing page, that splash page, when you guys are getting into North Star and into Matrix. So we've seen a little bit of an increase here in Minnesota. They're showing that as well. I think I've got Wisconsin here, which is not quite above zero. I've got Iowa, which is a little bit above zero. Ohio, not quite above zero. California, still about 50% below where they were at the start of the year. So kind of interesting there. Massachusetts, still below zero. North Carolina, also below zero. And I guess I left Ontario in there, still well below zero as well. So let's just look at the share of employment in the most exposed sectors, right? So leisure and hospitality, right? 23% were kind of highly exposed sectors in Nevada and Florida and South Carolina. How about Minnesota and Iowa and some of these sort of upper Midwest or upper Plains areas? You know, we've got a much lesser share of our economy that's exposed to what you might think of as high-risk sectors, or I guess I should say highly impacted sectors. And again, leisure and hospitality were two of, well, leisure and hospitality is technically one sector. Leisure and hospitality was one of the hardest hit, if not the hardest hit sector, as we saw earlier. So, you know, not saying we're immune to everything, and I guess that term has dual meaning. I'm not saying that we'll, you know, I'm not saying that we're going to be perfect here, but we are not as exposed as some other parts of the nation. So I thought that was worth pointing out. Ah, yes, mortgage rates, 30-year fixed. How is this one looking? Well, at least it's not at 18% anymore like it was in the early 80s. I know some of you remember that and reflect on those days fondly. Could this one be a little bit of a silver lining for buyers? You know, I want to say again, not to downplay any of the harm and the hurt and the very real impact of this whole CV-19 pandemic, but you know, I think it's worth pointing out what has been happening with rates. So this is what I was saying. Let's just fact check myself here. Late 2018, that's when rates kind of almost flirted with 5%. So again, early 2019, they were still coming down from those levels. So I think that's something else that's sort of noteworthy. And it wasn't really until maybe second half of last year when we started to get, you know, into the 3.6, 3.7, 3.8 numbers that, for better or for worse, I think consumers have kind of become conditioned to and accustomed to. But one thing is for sure, rates will not be below 4% forever. That I can guarantee you. You know, this whole rate decrease has set off a huge refinance wave amongst our friends in the lending side of the real estate space. So here's MBA's refinance index, the Mortgage Bankers Association. Quite a large wave of refinance activity, even larger than that kind of mid-2012, early 2013 wave. Almost on the same scale as that 09 refi wave. So you guys can really see just how much these low rates have set off refinancing. And by the way, you know, that's a good thing. It means, you know, typically, unless I suppose you refi into a 15-year, but if you go from a 30 to a 30 and you've been making payments, you know, your payments should be less. That should mean that you're a little bit more able to save for a down payment for the next one. So this is a good thing. How about gas prices? Might this be another silver lining? You know, here we are, gas prices, we're kind of all dressed up with nowhere to go. Gas prices down to nationally, what looks like 1.75, $1.75 a gallon. Some of us remember when we were at $4 a gallon, and now I know some of you can't even believe that you're seeing a $1.10, $1.25. I actually heard someone in the North Metro, can't remember if it was Coon Rapids or Andover or where exactly, but they said they saw 95 cents a gallon. We live in incredible times, my friends. So again, all dressed up, but nowhere to go. Miles driven, US. Here is, I think this is from Feb 2nd, yeah, Feb 2. So that's where we started at, saw growth into March, and then we started to see a decline as the world changed for us. And recently, 42% decline in miles driven, so no wonder. Another note, since we had our chat last week, some of you have noted some of the turmoil, again, a dual meaning, some of the turmoil in energy markets. For a moment there, the price of a barrel of oil went negative. Because we're driving so much less, and because the Saudis and the Russians are still producing, and a lot of the other OPEC countries are still producing oil, there are now tankers circling our globe filled with oil with nowhere to go because they just can't park it. And so many of the reserves are filled up. And so that's why we saw so much turmoil in energy markets. It was a pretty crazy thought to think that if I am an energy producer, if I'm Chevron or Exxon or Shell or whomever, I have to pay you to take a barrel of oil off of my hands. That's a pretty crazy thought, but here we are. Okay, so let's think a little bit about the stock market and how home prices have performed after a major change or decrease in the S&P 500. So here from 2000 to 02, we had a 45% correction after our dot-com bubble burst, as well as some of the fallout from 9/11. In the year 2000, home prices actually rose 8.5%. 01, 6.5%. 02, 8.5% again. So, yes, the economy affects housing, and yes, housing affects the economy, but they are not the same thing. And let me also say the stock market is not the economy. And so, the economy is not housing. Housing is not the economy, and stocks are not the economy. Repeat that back to me 5 times fast. So even though we've seen these declines in stocks, we haven't necessarily seen declines in home prices. So just because markets are down 10, 20, 30, even 40%, it's not a foregone conclusion that home prices have to come down. This one takes a look at home prices during the last 5 recessions, but be careful here. This is new homes only. This is borrowed with permission from KCM, Keeping Current Matters. I think they do a pretty good job of kind of highlighting some of this content. So home price change during the last 5 recessions, 1, 2, 3, 4, 5. This 1980 recession, actually home prices were up. 81, there was a second little recession. Home prices also up. 91, they were down. 01, they were up. And then 08, of course, they were down 19, 20%, but that was a housing-caused recession, right? So back here in 08, hard to think that was 12 years ago already. In 08, it was actually housing that brought the economy down. Now, might the economy bring housing down? Perhaps, perhaps not. But this was really a different situation, just given the mortgage crisis and the subprime lending crisis and all the home equity that people were taking out of their homes, so they had very little equity left as cushion for some market changes. Let me also throw in one more thought here. In 08, we were very much oversupplied, right? So when the rug kind of got pulled out and buyers disappeared, of course, sellers had to chase everyone down, including builders, especially with condos, had to kind of chase everyone down. Now we find ourselves in an undersupplied kind of environment. So again, I think we'll fare better. I also don't think this recession, assuming we're in one, and I'm fairly convinced we are, and I'm fairly convinced we'll be in one for at least several months or quarters. Not sure about years, but it's unlikely that it'll cut as deep as that one. So let's pivot now to all sales. So similarly, start of a recession versus the end of a recession. Here we have that 73 to 75 recession. We see price gains. We see growth in home prices there. We similarly see an increase in home prices here. Same with that 81 to 83 recession. Same with the 90 to 91 recession. Same with 01. And again, the only recession of the last 6, if you're talking about all homes and not just new, the only recession of the last 6 where home prices decreased was the most recent one, which again was a housing caused or housing induced recession, or at least a housing finance induced recession. Okay, a little bit of recency bias. So buyers who are still out shopping, there's some evidence they're biased by 2008 in that they expect lower prices. So we just saw that doesn't happen for most recessions. And again, we still don't have that oversupply issue like we had 10, 12 years ago, where sellers had to kind of drop prices in order to compete and get rid of the homes. So look at this. 63% of home shoppers are expecting lower prices. That leaves about 37% who aren't. So this expectation could be holding some sellers back from listing, in addition to health concerns. So if sellers are kind of getting, getting wind of this, that almost 2 in 3 buyers are expecting some deals, maybe they do hold off 3 months or 6 months or 9 months or a year or whatever. But remember, most sellers are also buyers. So if they're not selling, they're also not buying. So there's a little bit of a feedback loop there. All right, a little bit of an update on the alphabet soup. Most of our friends on Wall Street are still forecasting somewhat of a V-shaped recovery. I mentioned alphabet soup. Some folks are calling for a U-shaped recovery. Others are talking about a W-shaped recovery where we kind of have this double bottom before we get back. Other folks have talked about an L-shaped recovery where we kind of go down fast and we kind of stay down for some time. I think that's fairly unlikely. And then there's been this other thing, this the check mark, or maybe the Nike swoosh, where we came down pretty sharply, and I think we'll increase steadily, but I don't think we'll come back quite as quickly as we came down. And that speaks to the U-shaped recovery as well. So that comes down quickly, stays down for a little while, but then comes back really fast. The U-shape comes back way too fast. So that's why I think maybe a Nike swoosh or a check mark, or maybe a wider shaped V or an asymmetrical V could be a little bit more accurate. So again, we see a little bit of that check mark here, or swoosh here. So I think this is a pretty good model, and let's just spend a moment walking through it. Things have come down fairly sharply, a fairly severe drop that we've seen. An initial bounce back after some of the restrictions are lifted. So I know most of our restrictions aren't lifted. Maybe that's beginning in some states around the country. Some interesting news out of Georgia and elsewhere. So slow growth. So once we come down, maybe this initial bounce back, and then maybe we have slow growth until the health issue is under control. And then I think the growth path, as is noted here, the growth path really depends on how much pent-up demand, how much pent-up supply, and really what's the effect of these of our stimulus and monetary and fiscal policy. So if our stimulus is working and the Fed is able to backstop mortgage markets, credit markets, and other sectors, we could come back a little bit more quickly than if the efficacy of some of our interventions is not as robust or positive as we would have expected. It could be obviously a different growth trend line there. Well, here we go. V-shape. Our friends at Metro Study, again, borrowed with permission. I always like to cite my sources. Our friends at Metro Study are saying that the V is probably too sharp. Like I said, the U is probably too long at the bottom with too abrupt of a rebound. So they're actually talking about a swoosh or a check mark, right? So this is their forecast. This is not our official forecast. We don't have an official forecast on the shape of the recovery, but they do. So I just wanted to show you what they're saying. Again, not necessarily an endorsement, but I will say these are pretty smart folks who have a lot of folks in their research and forecasting departments. So I think it's worth just kind of looking at. So here's that sharp pullback. And then, depending on, a lot of things, mostly those three things that we talked about at the beginning, that's going to kind of determine the path of the recovery. I won't spend a ton of time here. Just know that 07, 08 recession really cut deep and wide, and it actually took nearly 14 quarters to kind of get back to 100% of GDP. Let me reiterate, most recessions look nothing like that 07, 08 recession. Most recessions actually, get back to 100% of GDP after, 3 quarters, some 4 quarters. So, what does that say? We could be back if this recession looks like any of these, that suggests we could be back by 4th quarter this year, 1st or 2nd quarter next. So maybe that's not as bad as some people thought. Maybe that's worse than others thought. I'm going to keep this one in this week. I'm gonna climb out on the skinny branches and say that you guys, when you woke up today, you weren't expecting to see a Hong Kong GDP chart for 01 to 04. But again, life is filled with surprises. So here's Feb of 03. That's when the SARS. That's when the onset of the SARS virus kind of started. That's Feb of 03. we can see the actual GDP trend in blue versus the overall trend in gray based on the growth trajectory. So the virus hits Feb of 03. It looks like things kind of bottom out by June of 03. And then it looks like, at least for Hong Kong in 01 to 04, it actually looks like their GDP actually got back on track by October of 03. Not saying we'll look like this, not saying we'll look different than this, just saying this is how another part of the world, of the developed world, dealt with this, and how how it impacted GDP and how quickly it came back. We are not Hong Kong. Hong Kong is not us, and the world is different now than it was in 02, 03, and 04. So again, just saying that there are examples of a fairly significant viral outbreak that hit a developed nation, or maybe a developed city-state, and it did come back fairly quickly. Our results may vary. All right, so mortgage originations, here we have the subprime crisis. You guys can see a lot, well, almost all of that ended by, mid 06, 07. By the time 09 came around, there was almost no subprime, which kind of left conventional and FHA loans. Well, let's think a little bit more about that. Let's also think about home equity. 06, homeowners took $85 billion out of their homes, right? $85 billion out of their homes. Now they're more like taking 20 billion out. So there's a much bigger cushion were anything to happen. Folks, shoppers are using technology. Look at the growth in 3D home tours. We've really seen an increase here. This is Zillow data, so maybe I should request your forgiveness for that. Interest in housing remains elevated. Google search, should I buy a home? Right? Maybe rates are encouraging to people. So we still see this Google traffic. And what do you do before you schedule a showing? You do a Google search. What do you do before making an offer? You have a showing. What do you do before you close on a deal? You sign a contract. So again, this is getting back to that life cycle of a listing. Let's get at the thing before the thing before the thing. Yeah, let's skip some of these guys. I want to get to some of my closing slides here. I know we're running a little thin on time. So this one's interesting. As rates went from 4% to about 3.5%, you're talking about $1,000 a year in savings. And here in Minneapolis, folks can afford, I don't have an exact figure, it looks like $17,000 more home, from 3.5 to versus 4%. Well, maybe a typical $300,000 home may appreciate that much, anyway. So take that with a grain of salt. And let's pivot here. Forgive me, you guys. I'm going to skip ahead just a little bit, just because we're a little shy on time. Let's see. I want to skip to this one. I know you guys are wondering about home prices and what'll be the impact. Again, the short answer, I don't know. The long answer, it depends on those three things. And let me just mention, we are undergoing a big shift, but it's not like we haven't seen big shifts before, right? We know that we have. Shopping, contactless pickup and delivery, right? Is that going to move the needle? Rentals and condos, what about shared spaces? Are people going to be concerned? How about coffee in restaurants? If we're finding we can make our coffee at home and cook at home, how does that change the Starbucks model or the, the Olive Garden or Wendy's model? I don't know. How about commuting versus working remotely? If we're finding that workers can be pretty productive from home, do all businesses spend top dollar on Class A downtown commercial real estate? Now, I know most of us aren't commercial agents, but again, just something to think about. And what about the trust element in the economy, in our leadership, in our health system? Just some kind of ways of thinking about how things could look as we come out of this. Okay, I have to do this last one only because it really made me laugh. I hope you guys get a laugh out of it. This is from one of my favorite stock traders that I follow. Amazon has become a utility in this crisis. Defensive, reliable, indispensable. Netflix has become like a pharmaceutical. An inadvertent cure for mass anxiety, a panacea for a populace trapped in their homes. And then this guy responds, take 2 Tiger Kings and call me in the morning. I just had to get a quick laugh out of that one. So that's all I have prepared. I want to say thank you guys for joining us today and tuning in. I also want to say wash your hands. And I know we didn't leave a ton of time for questions. Forgive me on that. But I think we'll be entertaining a couple questions now if you guys have any.
David, we did have a few people reach out. The two questions that came in while you were presenting was that somebody had asked about virtual showings, and did that start last week? Just wondering if that is a bump for some of the price points.
Ooh, virtual showings last week and price points. That's a good one. I don't have a good answer for that. I'd have to think about that one.
Might be something to think about for next week's presentation, huh?
Yeah, yep, that's a good one.
And then somebody had asked if you could share with the group which content is available to agents to share, i.e. can the Kipling information be used on social media?
Yeah. I mean, I have permission, of course. I'm pretty sensitive to this, only because we've seen some people use our content maybe without all the permissions they should have sought out. So I'm pretty sensitive to that. I know this is from NAR, so I know that's good to go. Like I said, I got permission from who was that? Our friends at. Well, yeah, I have permission from the Keeping Current Matters, so I know that's good to go. I know I have permission from, this is NAR and Myers Research. This is KCM. I think most of these are okay as long as nobody claims them as their own intellectual property. So I would encourage folks not to crop out some of the sourcing and just to leave the sources. And then you're not saying that this is your original content. You're at least, citing your sources. So I think you're safe. I really do.
Great. Those were the only ones that came in via chat. Does anybody have anything else? I mean, you can unmute yourself if you're not afraid to speak in front of the group. You don't have to show yourself.
I'm going to ask only because I can't figure out how to find my chat box. Where can I find these slides to share?
You will get them.
Oh, okay.
Yeah. So what we'll do is, David, after he's done with this presentation, he has to size them down other ways. Unfortunately, it's too large of a file to share. They'll be put into a PDF and we'll email them out to all of the registrants. And the recording you can find, like I said, on our website. If you go to the mplsrealtor.com and then on the COVID-19 resource page, that's where you'll find every week after the session is over, we post the recording there. Great questions.
Any others?
Well, if there isn't any, thanks for coming today. Hopefully you guys continue to find this beneficial. Like we said, David's back every Tuesday at 2 o'clock, every Tuesday, Thursday. Who knows what day it is anymore, right? He will be back next week on Thursday. Registration is required, so we prefer it anyway, so we can get you the link ahead of time. And then again, just a reminder, we'll be doing the same thing with Government Affairs Director on Monday, Eric Myers, on Monday at 1 o'clock. So if nothing else, we'll see you guys hopefully next week.
Thank you so much.